Good afternoon, everyone, and welcome to our first economic update on the markets and how they may impact you. I'm Terry HORAN, president of HORAN. There's an old Chinese saying, may you all live in interesting times. We didn't know that they had to be this interesting, however. We intend to host this webinar every Friday at around 2 p.m. to share HORAN's financial perspectives until we get through this crisis that our nation and the world is currently facing. We're recording this session, and it can be shared with you later today. We'll also have the slides available to you if you request a copy of it. Just contact us at HORAN and we'll get them to you. Let me give you just a brief HORAN overview before we start. We're open, however, we've asked most of our staff to work from home if possible, and 75% of them are actually doing that. That leaves a small team in the office each day, most of them associated with our wealth business. And most of the office team works behind closed doors, and of course we practice social distancing. Accessibility is our top priority, and we will continue to be diligent and proactive in our communications with you. I want to credit our information technology department. They're working overtime to keep data and communication lines open while maintaining an abundance of caution to make sure our data and your data is safe and secure. Our marketing department is working hard to keep messages and information flowing to our clients and prospects of how we can help you through this period of uncertainty. Since last week alone, our marketing department has sent out 7 communiques designed to help our clients navigate this period of great uncertainty. And you're welcome to get copies of those if you don't already have them and would like them. By Monday, we'll have a landing page on the HORAN website that will serve as a hub of resources to support you and your employees if you have them. Here at HORAN, we focus on 27 fundamentals throughout the year that align with our core values and drive our decision-making and service. Coincidentally, this week's fundamental that we're focused on is delivering legendary service. And we kick off each meeting during the week with that fundamental. And we hope this is an aspect of our ability to deliver legendary service to you. It's about doing the little things as well as the big things to delight our clients. We want to create extraordinary experiences, and in doing so, hopefully create a long and enduring relationship with you by doing the unexpected for you. Over the past 2 weeks, we've been fielding calls from you that unsure of what actions to take or perhaps not to take. Certainly the financial markets are in uncharted territory. And today we'd like to talk to you about the economic outlooks, the reactions to and from Washington, and what all of this might mean to you. Hopefully you'll get some of your questions answered today. We have a great group. I have a great team of people from HORAN in the room with me. First, Paul Carl, who has 33 years of industry experience, 8 of them with the Department of Labor. Paul uses his fiduciary expertise to serve a large variety of businesses in their retirement plans, ranging from Fortune 100 companies to small independent organizations, designing and implementing and operating qualified and non-qualified retirement benefit programs. Michael Napier, a CFP, is in the room with us, and many of you perhaps know him. He helps clients in crafting detailed financial plans and coordinating investment strategies. His focus is to assist individuals and families with all aspects of their financial future. Todd Poline from HORAN Capital Advisors and a CFA is in the room also. He's responsible for meeting the investment needs and planning needs of high net worth clientele. His experience with families, defined benefit plans, foundations, and endowments are invaluable to our portfolio management team. Greg Hornschmeyer is also here. Greg is both your personal advocate and insurance consultant for individuals and businesses. He works with clients to successfully navigate the complex world of life, disability, and long-term care products. He'll bring a fresh perspective, a knowledgeable discipline to a subject matter that many view with apprehension, in order to provide better care and greater security. So Todd, I think we're kicking it off with you.
All right, well, thanks, Terry. Good afternoon, everyone, and thanks for joining us here today. I wanted to start out by giving an update on the markets, discuss what we were seeing in the economy, including actions taken by policymakers, and lastly, provide an update on activity in China. You know, it's hard to believe sitting here today the markets were sitting at all-time highs just 1 month ago. Since then, we have clearly seen a swift sell-off in the markets and heightened levels of volatility. On March 11th, the S&P 500 index entered a bear market, which is defined as a 20% decline from its peak. It took less than 1 month to reach this point and became the fastest bear market ever. To put it in perspective, historically, it has taken an average of 8 months to enter a bear market. Now, over the past few weeks, we've also experienced extreme levels of volatility in the markets. Up until yesterday, we had 8 straight days of plus or minus 4% moves in the markets, as noted on the right-hand side of this chart. While we understand these swings in the markets can be unsettling, we think it is important to understand what has largely been driving this volatility. It appears most of this has been driven by short-term traders and institutions like hedge funds that are being forced to reduce leverage in their strategies. This has led to dramatic swings in individual stocks from one day to the next. As reported by BlackRock, they have not seen much selling by individual investors, although they did note it has picked up a little bit here in the past few days, and that importantly may be an indication we are starting to near a bottom. Now, over the past month, there have been very few places to hide for investors. As you will see in the middle section on this page, most equity markets are down year to date in the 25 to 30% range and are down approximately 30% from their peak levels back in mid-February. As shown in the top section here, most areas of the bond market outside of U.S. Treasuries have also been under pressure, largely on fears of companies' ability to repay their debt. Leading up to this crisis, we were actually seeing a strengthening in the U.S. economy, both here in the U.S. as well as abroad. The U.S. consumer in particular was in good shape with record low unemployment and rising wages. As illustrated in these charts, the consumers had improved their balance sheets by reducing their debt levels to record lows, and personal savings rates had risen up to 8%. We believe the strengthening of the economy and the overall health of the consumer may help to mitigate some of the economic impact from this virus, but we do also recognize many of the jobs being impacted by this are lower wage positions where people may be living paycheck to paycheck. This is why we think it's important for policymakers to act quickly to inject stimulus into the economy. We've already seen very aggressive action by central banks to both lower interest rates as well as inject liquidity into credit markets to help ensure those markets are functioning smoothly. Central banks around the globe have also been following suit to help support their economies in dramatic fashions. This slide highlights some of the both monetary stimulus as well as fiscal stimulus implemented to date here in the U.S., as well as some potential actions on the horizon. And frankly, this page is changing by the day. As you've probably seen over the last 24 hours, Congress is now working on a phase 3 fiscal stimulus package that is estimated to be $1 trillion or more. As has been reported by China, China appears to control the spread of the virus and reported no new infections actually on this Wednesday. After instituting a quarantine in late January, we saw their number of reported cases peak about 2 weeks later. While these reports may be met with a degree of skepticism, we take comfort in announcements from companies like Apple and Starbucks that they are reopening their stores there. We also heard from FedEx earlier this week that China demand has rebounded more than they expected. They noted 90 to 95% of large Chinese manufacturers are back operating and about 2/3 of small businesses are operating. We believe this could be an indication of what we could see in other countries once the spread of the virus has been controlled. We don't know exactly when, but we do believe we will emerge on the other side of this. The second and potentially third quarters will likely show contraction here in the U.S. economy as well as abroad. We remain in the camp that this is not like the recession of 08 and 09, where the primary cause was a failure of the financial markets themselves. But we would note markets will likely remain volatile for the coming weeks, if not months, but we would expect a recovery to begin by the third or fourth quarter of this year. We would highlight equity markets are back to valuation levels that could prove to be quite attractive for longer-term investors. It is also important to remember markets will likely discount a rebound once the data becomes clear around the long-run effects on the world economies, as well as the trajectory for corporate earnings. We would encourage investors at this time to take a deep breath and have a long-term perspective. With that said, I'm going to turn it over to my colleague, Mike Napier, to discuss what bear markets have looked like historically and managing through this market volatility.
Thank you, Todd. Good afternoon, everyone. So the new bear market, we are in the new bear market as we speak. And as Todd spoke, a bear market is a 20% decline from its peak. And so 13 bear markets have happened since World War II. So World War II was in the 1940s. The average decline in a bear market is 32.5%. So that's from its high to its low, 32%. And we're at 29.7% on its low right now, from the top to the bottom. The average bear market occurs every 6 to 7 years. We're on year 11 since the 2008-2009 bear market. As Todd spoke about, this bear market is different than others because this bear market initially happened because of a virus instead of an economic turbulence. This bear market has occurred over 16 trading days, when most bear markets occur over 6 to 8 months, which is roughly 116 trading days. If you look at the chart on the right-hand side, this goes over all of the past recessions we've had since World War II. So we've had 11 past recessions since World War II. If you look at the columns, you've got the time period, you've got the peak to decline, peak to trough decline, and the 6-month return after the trough or after the bottom of the market. So the last column down was the last bear market we went through, which was the subprime mortgage bear market, which was October 2007 to March 2009. The peak to trough decline in that period was 57%, 57% from the top to the bottom in 2008-2009. If you look for the 6-month return after the trough, so the bottom of the market in this particular bear market was March 9th of 2009, was the bottom of the market for that time period. Once the bottom of the market occurred, we had a 50% increase in stocks in the index over the next 6 months. And I can tell you the majority of that increase was over the first 2 months after the decline. The point on this slide, and the point we're trying to make, is we must keep our asset allocation. We must keep our asset allocation in our plan. And if we're having emotional or we're having signs that we want to make a change, to talk to our financial planner or our trusted advisor to walk through those particular steps. We do not want to miss the upside, the appreciation that we could get with these particular bear markets. Managing market volatility. So this has to do with asset allocation, keeping your plan. Some folks call it in their 20s and the 30s might have 100% in stocks. So 100% in stocks for some folks, 20s, 30s, people with high risk. Many of our retired clients or soon to be retired clients have less in stocks, call it 50% in stocks or 60% in stocks. The whole thought of this is keeping to your plan over time. This particular chart in the middle talks a story of an investor that invested $10,000 in the S&P 500 in 1980. So this particular investor would have put $10,000 in the stock market in 1980. This particular investor, the first column, left the money as is for 38 years in the stock market. left to $10,000 in the S&P 500 for all 38 years. That return would have been $659,000. So this particular investor put $10,000 in over 38 years. They would have ended the 38-year period with $659,000. That's 11.2% return on their money per year for that time period. If that investor would have missed the best 5 days of the market, the best 5 days, 2 of which were shortly after the bottom in 2009, if they would have missed those best 5 days, they would have given up $232,000 in growth. Missing the best 10 days would have given up $341,000 in gross. Missing the best 30 days would have given up $534,000, and missing the best 50 days of the market for that 38-year time period would have given up $602,000 of growth. The point here is follow your plan. Ask questions to your trusted advisor throughout this time period, especially in the period we're in now. Going to pass this along to Paul Carl, that'll talk about what this means to you.
Thank you, Mike. So what exactly does all this mean to you? Well, first of all, if you have any stock exposure at all, guess what? You've lost ground. But there's no reason to panic. What you definitely want to do is avoid damaging your retirement or other long-term savings. Now is the time to use that emergency fund, that 3, 6, 9-month fund that you've set aside, especially if your cash needs are getting low. Also, take an opportunity to evaluate your lifestyle needs and wants, adjusting where you need to reduce expenses, and stay focused on your future. So a couple of questions that we get from now and then: should I be borrowing from my retirement plan? Well, you know what? It looks like a solution, but borrowing today takes money from an already reduced account balance, locks it in at a fixed rate in a place that may overall stunt your future growth. Loans also become an obligation to repay, so you could be adding another payment to your budget. Failure to repay usually equals tax consequences, and that may include a penalty. Hardship distributions are available in retirement plans, as well as taxable withdrawals from an IRA. The issue with those, either solution will eliminate their availability for the future. The long-term aspect of that, not compelling, because as you age, believe me, you're going to be glad that you have the funds. So some additional questions that we've been getting include, how do I invest through this, and should I reallocate? Well, frankly, as we've already hinted, individually, everybody has their own unique situation, and there's no one solution. We need to really stay focused on the future. Here at HORAN, we have a discipline that we follow. Hopefully you do too, and please give that strong consideration to maintaining your discipline. Prepare yourself emotionally before you look at any statements or your balances online. Frankly, they could come quite as a shock if you haven't looked for a while. And consider your whole portfolio, not just the part that's underperforming. You know, stocks have been beaten up pretty badly, but there's some other aspects, cash, bonds, that they've maintained some strength, maybe even gone up just a little bit. So for those of us, or those out there that have established investment objectives, you built a roadmap some time ago. That roadmap was designed exactly for these occurrences, to keep the emotions out of it. No established investment objective, well, that's still not a time to panic. So I want everyone to really focus on the screen right now. This is a chart that our friends at PIMCO Mutual Funds put together and shared with us. What's really pertinent about this is if you participate in a 401k or a 403b plan and contribute on a regular basis. What you've been doing is averaging into the stock market or the investment market. It's called dollar cost averaging. Until recently, participants have been buying on the way up. On the way up, it gets more expensive. Now participants are buying on the way down. Things are on sale. The challenge is our emotions. They can get the best of us. This particular chart looks at 2006 through 2011. It kind of looks like a roller coaster if you really pay attention to it. Market's up, feels good, we want more. Market's down, feels bad, we want less. So some questions that we've been getting also, how do we take advantage of this market? Well, first of all, we're not proponents of market timing. Again, we prefer that disciplined approach. The question is, can you afford to increase retirement contributions, even on a temporary basis? You know, now might be a good time to do it. Even for those individuals that have plotted out their course to maximize IRS deferral limits in your 401k, maybe consider increasing contributions now and then adjusting later. Make your 2020 IRA contribution now. And if you haven't made a 2019 IRA contribution, that deadline is April 1st, so you still have time. And finally, if you've been holding some cash, waiting for a market dip or correction, guess what? We're in it. So you might consider working that in as well.
Thank you, Paul. We also have Greg Hornschmeyer here in the room, and he has worked with me in the life insurance business for, we probably have collectively about 80 years.
Don't give our age away.
Yeah, don't give our age away, right? But anyway, Greg, how can we use our life insurance portfolios at this time?
Thanks, Terry. It's a great question. Like Paul had mentioned, you may not want to open up your statements unless your insurance is in force. It might give you a heart attack when you see these losses. I know I certainly looked at mine. I think most people, they don't realize insurance is an asset, not just an expense. I think sometimes we write checks to life insurance companies and think we're paying a bill. In reality, they really are an asset, especially if you have cash value life insurance, such as whole life, indexed universal life, variable universal life, or universal life. Many folks don't know that you can't access the cash value through withdrawals and loans. Those withdrawals can be tax-free and create a stable, provide some stable income during this downturn, which a lot of people don't realize they can do that. So those are useful tools to take advantage of. If you have a universal life or a variable universal life with a guaranteed death benefit, those contracts are very advantageous in a market volatility that we're going through right now. As long as your premiums are paid on time, those death benefits will be guaranteed regardless of what the market performance is. So make sure you pay attention to your policy and pay your premium on time. If you have a term life insurance policy, these products are typically guaranteed over a 10 to 30-year period. They don't have cash value, but they do provide liquidity for your family, for living expenses, as well as for business owners. But make sure you have the expiration date and any conversion options to cash value life insurance that might be available on those products. One thing that I've been asked a lot this week from a lot of my clients is the stability of life insurance companies and how does the market downturn affect them as far as paying claims. Actually, insurance companies have much more stringent funding requirements than banks. And I like to look back, 9/11, I pulled a quote out from the CEO of New York Life. There was over $52 billion in death claims paid for the 9/11 incidents. He had mentioned that was, although as tragic as it was, it did not really have a material adverse impact on the industry. So the life insurance industry is very well prepared for claims, and they do have cash on hand if you want to withdraw money out of your policies. Same goes for disability and long-term care. Insurance companies have reserving requirements on those institutions as well, so they will be there for claims paying as well.
Thank you, Greg. I appreciate that. We have a number of questions from the audience, and I'm going to ask the team here their questions. It's a couple of these questions. In the time we have remaining, we're going to try and stop this about 2:30 and see how they answer them. Basically, a lot of the questions surround the idea, should I get out of the market now and buy back once the market hits bottom, or what are the best options to recoup the losses that we've seen so far? So Todd, Michael, go right ahead, Michael.
Sure. Terry, I think I'll answer this question like this. I had, in the 2008, 2009 bear market, I had a client, we were calling our clients and giving them advice to stay the course of action on their particular plan. The market continues to go down and down and down. We're continuing to have this conversation with them. I had a particular client that rode the market down in 2008. This particular client had a lot of money, roughly $1 million, and the bottom of the market was March 9th of 2009. And this client called me that day, March 9th of 2009, and said, I'm done, cash me out. So he went all cash, bottom of the market, 2009. It's easy to get out of the market. It's easy to pull the trigger and call your advisor and say, get me out of the market. It's harder to get your money back in the market. So this particular client, I ran into, he left our firm shortly after he cashed his money in, and I ran into him 2 years ago it was actually at a church fair, and I said to him, how's your portfolio? Did you get your money back in? He said, no, I did not get my money back in yet. So he missed over a 300% return by getting out, putting it in money market. It's harder to get out than it is. I mean, it's easier to get out than it is to put your money back in.
Todd, any insights?
Yeah, so I would add on, I think I agree certainly with what Michael shared. Our team on the HORAN Capital Advisors team believes this is presenting us an opportunity, to take advantage of this for our long-term investors. Really everything in the equity markets is getting hit. And so this has been a great opportunity for us to look at other companies that we've looked at and researched in the past and just perhaps haven't been comfortable with the valuation level on those companies. But now we're seeing opportunities to buy them and frankly upgrade, the caliber of the portfolio. And so we do believe this for long-term investors will be a good opportunity. Obviously, no one can predict for sure exactly when we might see a bottom, but it makes sense, we think, over time here to, start to slowly deploy some cash.
Yeah. If I could just add an insight, people have asked us and our team, how are you able to do research when a lot of these people are living at home or working out of their house? How's the research on different investment ideas? And frankly, in a way, it's never been better. People have time on their hands, so it's easier to talk to companies, and it's easier to talk to our resources who give us advice on a fairly routine basis, easier than ever to get in touch with them because we're at home. They're not on the road, they're not traveling, and we're having better conversations with them. Another question that has come in, and that is, I plan to retire over the next couple of years, and people are saying that it might take a long time to recover from this. Should I get out now before I lose any more?
So the thought through that is very similar to what we've been talking about, sticking to your asset allocation, sticking to the plan that you and your trusted advisor has put together. The risk of getting out of the market, is the risk of missing the upside return after the bottom of the market, kind of what I spoke with about the new bear market slide. So the thought is making adjustments. If your emotion is very high, if you've got a lot of pain, call your advisor, talk to your advisor about ideas for the future. But the risk is you're going to miss the upswing when the market becomes a little bit more clear on this particular virus.
Paul?
Yeah, I'd just like to add too that, as you get closer and closer to retirement and situations like this occur, and maybe you weren't completely properly allocated and given this situation, you're going to need to be flexible. You're going to need to think about delaying retirement for a year or two or three just to reaccumulate some of those savings and let the market bounce back a little bit longer.
Todd, did you want to add something?
Yeah, I think, and the other thing to point out, I think, is, the reality is you may be in a position to where you have the time on your side to allow your equities to recover. And working with our clients here, we make sure we structure portfolios to where clients have at least 2 to 3 years worth of living expenses covered between their allocation to cash and fixed income. And so the reality is, even though the value of your portfolio is down a lot, the reality is you may have enough money set aside between your cash and bond part of the portfolio to weather this storm and allow your equities to recover. And a big part of that that enables us to accomplish that here is our financial planning process that all of our clients go through. That helps to pinpoint, here's what you need to cover your living expenses per year, and then we can then utilize that information to structure the appropriate investment allocation for you.
Thank you, Todd, Michael, Paul, and Greg. It's been a great half hour. We're going to repeat this next week. We had a marvelous participation here from our clients and friends tuning in. And so as long as we have this type of participation, we'll continue these Friday afternoon conferences. I want to make you aware of 2 other webinars HORAN is doing on March 23rd and 26th. They're entitled, Where Do We Go From Here? Elections, Healthcare, and the Decisions Ahead. We're partnering with Sun Life Company's Assistant Vice President of Government Relations to discuss how these dynamics are going to impact the employee benefits industry. So that's next week, March 23rd and 26th at noontime. So sign up for any of these on our website, www.HORAN.Associates. Changes and updates are obviously occurring daily, and we will strive to continue to deliver legendary service to each of you. Thank you for letting us be your trusted advisor. Good afternoon.